Hi there, Evan here at the Chronicle, where the future starts today. For September 29th, 2019, two things I wanted to cover here on this Sunday evening. First, the Canadian average weekly earnings for July came out a few days ago. It really didn't get too much play, to be honest, throughout the media and Twitter also as well. But go ahead and let's cover it here real quick. The number was up 2.7% year over year. We'll get into the internals of it, which frankly shows this wasn't a good report. Hours worked, down 0.2 of 1 hour year over year, so a decline of approximately 0.6 of 1%. Construction, average weekly earnings only up about 1.5% year over year. Retail, up 1.7% year over year. Accommodation and food service, up 2.2% year over year. Manufacturing was up 3.7% year over year, but even StatsCan admits it here, all the growth was in the fourth quarter of 2018, and as the fourth quarter of 2019 quickly approaches, the comps will get more difficult, and we'll see a market slowdown there, I am sure. The only bright spot, though, wholesale trade was up 3.6% year over year. But look, I'll link the report down below for you if you do want to read it for yourself. This candidly was not a good report. As I've said many times on this channel here, total wage growth really since the first quarter of 2018 in Canada has been anemic. It remains anemic. You have this in combination with debt servicing ratios in Canada that are still at all-time highs. You have consumer insolvencies that have been picking up really since the middle of last year. You had this on top of the fact that we've already seen massive price declines in both the Toronto and Vancouver detached market and the Vancouver condo market as well. In Toronto, I do think we're going to start seeing that flow through very soon also. And also add in the fact that unemployment bottom ticked earlier on this year at 5.4%. It's now gone up to 5.7% in Canada. And as I said roughly a few months ago here on this channel, when the unemployment rate ticks up 0.4 of 1% from the bottom, so far we're at 0.3. It usually leads the masses knowing we're in a recession by 6 to 12 months. So be on the lookout for that. But really, to summarize, the trend is your friend. Nothing has changed here. We're going to go ahead and stay with it. And lastly, I want to give a quick update here on the overnight repo market in the US, and also add in the 14-day repo market. Currently, the Fed is injecting $100 billion into the overnight repo market daily and $60 billion into the 14-day repo market daily. Why am I mentioning the 14-day? It was massively oversubscribed Thursday of last week. Friday, it did slow down on both somewhat. Although I do find it kind of funny that on Friday, news comes out that the Trump administration was considering capital restrictions on Americans buying Chinese stocks and Chinese ADRs that are trading in New York. So the day before that, we see the 14-day repo market massively oversubscribed. Now, Zerohedge had an article yesterday stating it was the US banks that had declines in their cash levels, not foreign banks. Now, what I think has happened here, again, this is speculation on my part, I've mentioned this in a previous video also, is that Chinese companies got ahead of this, started pulling money out of the US, and that's the reason why that the domestic banks had to go ahead and massively tap the repo market. That's honestly what I think happened here. And coincidentally, the timing of this is the day before that announcement comes out about the capital restrictions of Americans buying Chinese stocks. I wonder. Now tonight, word's broken that the US government has denied that, but nonetheless, the timing here is kind of fishy. I'll go ahead and leave it there. Really, that's all I gotta say though. Smash that like button, leave a comment, subscribe, follow both my Twitter accounts, and as always, my name is Evan, this is the McChronicle, where the future starts today.